Local farmers must incorporate conventional business ethics in their operations if they are to attract the much-needed credit from financing institutions. Now, this comes as the African countries look for innovative ways to finance the sector, with the Kenyan government committing to lower interest rates of loans to the sector to single digits. Here is KTN's Philip Keitani.
For developing economies
Despite being made up of economies that rely on agriculture and spending in excess of $35 billion in food imports, Africa is still besieged by persistent cases of food shortages and starvation.
We know there are some tax regimes that always makes the sector very expensive, very unattractive. Again, that is where finance comes in.
The high interest rate charged by banks and other financial institutions are listed among the biggest stumbling blocks to the growth of the agricultural sector. But now the government of Kenya is stepping in to provide affordable loans to farmers so as to allow for the expansion and modernization of the sector, which would unlock the nascent potential in the sector.
How do you allow millions of Africans to work for a few people? We're literally slaves. I mean, somebody must do the right thing.
Players in the agricultural sector are also being challenged to find other ways of raising funds, while banks and other financial institutions urge to form a risk-sharing facility that will provide cheaper loans to farmers.
The shortage of credit financing, together with other constraints, has led to rapid decline in adoption of the majority of improved technologies and practices needed to raise agricultural productivity and to generate higher incomes.
Meanwhile, the government is encouraging players in the private sector to be more assertive in demanding for low interest rates so as to ensure faster economic growth in the sector. Philip Keitani, KTN Business.